What if the solution to the world's $150 trillion debt problem isn't a new invention? What if it isn't some complex algorithmic trading strategy or, a new central bank digital currency? What if the fix is actually a 2,000-year-old concept from ancient India, just, well, supercharged for the digital age?
It sounds like a complete paradox, doesn't it? I mean, usually when we talk about the future of finance, our eyes are on the horizon. We're looking at quantum computing, AI models, that kind of thing.
Exactly.
But sometimes, to fix the future, the data really suggests you have to look very, very far into the past.
Yes.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi. Unpacking something that, you're right, it feels like it belongs in a sci-fi novel, but it's actually happening right now as we speak in January 2026. We're looking at a system where credit was real. And by real, I mean it was backed by hard, tangible assets, not just promises or, good vibes.
Which is a crucial distinction, a really crucial one that I think most people miss. We're so used to the word credit just being a synonym for debt.
Right. You swipe a credit card, you have debt.
Exactly. But historically, there was this massive difference between credit backed by reality, by an actual asset sitting in a vault, and credit backed by nothing but a promise to pay later.
And here is where it gets really interesting for today's deep dive. This isn't just a history lesson or some theoretical exercise for economists. Strategy Inc., led by Michael Saylor, is already doing it.
They're not just theorizing about it.
No, not at all. They've created a new kind of financial instrument, a form of what they call digital credit. And it's designed to be more stable, higher yielding, and significantly more tax efficient than, well, pretty much anything you can find in the traditional bond market.
It's a direct challenge to what our sources are calling the unhinged debt market.
It is, and it's already attracting hundreds of millions of dollars. It's a fascinating pivot. For years, we all watched them just buy Bitcoin. That was the whole story.
Just accumulating.
Just accumulating. But now they're not just holding the asset, they're actually engineering a way to use it as a base layer for a new kind of financial architecture. They're trying to prove you can build a better bond than the government can.
We have a massive stack of research here for this one, mostly centered on this report. Digital credit, evolution, and future. We're going to break down the how and the why.
We really are. We're going to look at everything from the ancient Hundi system of India to the specific nitty-gritty mechanics of this new STRC instrument. But before we get into all that, I have a quick and very specific request. As you know, we're on a mission to hit 1,000 subscribers across all our platforms. And this isn't just a vanity metric. We need this to get funding for the Mosaic AI video editor. We really want to create high-quality companion videos for these audio deep dives so you can actually see the charts and the historical documents we're talking about.
It would make a huge difference in how we can present this data, especially for some of the more complex ideas.
Absolutely. So if you haven't already, please take a second and subscribe on YouTube, YouTube Music, Spotify, Apple, or Fountain.fm, wherever you happen to listen. And if you are listening on some other app, just let us know through the email in the description.
It really does help us keep these deep dives coming and, constantly improving them.
And one last thing before we jump in, do check out our YouTube course on STRC, The Future of Digital Credit. It's a free course. It covers more than 10 of these audio deep dives. So if you want to really geek out after this episode and see all the math laid out, that's the place to go.
Okay, let's do it.
Okay, so let's unpack this. The source material paints a pretty stark picture of the current state of things, right here in January 2026. It calls it the crisis of selling debt.
And it really is a crisis of structure, not just numbers. But you have to start with the numbers because, honestly, they're terrifying.
They are.
The report highlights that global non-household debt, so not even counting your personal mortgage or your credit card debt here, has hit $150 trillion.
That number is so big it loses all meaning. 150 trillion. It's impossible to wrap your head around that scale.
It really is. It has to break it down a bit to see where the real pressure points are. The U.S. is holding about 58.8 trillion of that.
The biggest piece of the pie.
By far. Then you have China with roughly 26 trillion, and Japan is sitting on about 11 trillion. But the scary part, the really scary part, isn't just the total amount. It's what analysts are calling the maturity wall.
The maturity wall. I mean, that sounds incredibly ominous. What does that actually mean for the economy?
Think of it like a giant balloon payment that's coming due for the entire world at the same time. The sources point out that 40% of all sovereign and corporate bond debt in the OECD matures by 2027,
40%, so in the next year or so.
in the next year. Now, think back to 2020 and 2021. What was the financial climate like back then?
Oh, it was the ZRRP era. Zero interest rate policy. Money was basically free.
Exactly. It was free.
Yeah.
Governments and corporations borrowed as much as they possibly could because the interest rates were near zero. It felt like free money. But now, in 2026, those debts are coming due.
You have to pay the principal back.
And since they don't have, 50 or 60 trillion dollars just lying around, they have to refinance.
They have to take out a new loan to pay off the old one.
Right. But you can't refinance at 0% anymore, can you? You're refinancing at much, much higher rates. It's an interest expense shockwave.
So it's like if your mortgage payment suddenly tripled overnight because your low-rate teaser term ended.
Exactly that. But it's happening to the entire global economy simultaneously. It's going to bleed corporations and governments completely dry.
So we have this massive, unprecedented pile of debt, and it's getting incredibly expensive to just maintain it. But the report argues this isn't just bad luck. It's a deep structural flaw.
It is.
And this is where the history comes in, which I love. It mentions a specific date that I had never paid any attention to before. 1704.
Yes, the Promissory Notes Act of 1704. This is one of those quiet moments in legal history that completely changed the DNA of money. And almost nobody talks about it.
So what happened?
Before this act, under English common law, a debt was personal. It was a relationship between two specific people.
Okay, so if I lent you money, it was because I trusted you, specifically, and not just anyone.
Precisely. And because it was based on that personal trust, I couldn't just take your IOU and sell it to a stranger down the street. That stranger doesn't know you. They don't have that relationship. The debt was what they called non-negotiable.
And there was a judge who fought to keep it that way, wasn't there?
There was. Lord Chief Justice Holt. He was a very prominent legal mind at the time, and he argued fiercely against this new idea that debt could be a negotiable instrument. He believed that turning debt into a tradable product would detach it from reality. He said it would lead to rampant fraud.
But he lost the argument.
He did. The merchant class, the financiers, they pushed back hard, and Parliament overruled him in 1704.
And that basically opened the floodgates.
It really did. They passed this act that effectively turned debt into a commodity. Suddenly, your personal promise to me could be bought, sold, and traded by people who had absolutely no relationship with you, the original borrower. That is the great decoupling the source talks about.
It shifted the financial world from issuing credit to facilitate a specific trade.
To selling debt as a product, just to generate cash. It became an end in itself.
And that trajectory, that decoupling, it continued for centuries until we hit the next major inflection point, the Nixon shock of 1971.
Which is really the final nail in the coffin for asset-backed money. When Nixon ended gold convertibility, he severed the last tether to physical reality.
Right. Before 71, there was at least a theoretical link. You could, in theory, exchange your dollars for a set amount of gold.
In theory, yes. But after 1971, credit became purely unsecured debt. There was nothing behind it.
So what was it backed by then? What is it backed by now?
It's backed by three things, and none of them are tangible. Faith, the printing press, which is just a fancy way of saying inflation and future taxation.
So the collateral is just a promise that the government will tax our children to pay it back.
That's the system. It's an IOU written against the future earnings of people who haven't even been born yet.
So fast forward to today, January 2026. We have this system based on selling debt to fund things like stock buybacks or just to cover operating deficits. It's consumptive, as the report says, not productive.
Correct.
And on top of all that, we have this new massive pressure, AI.
The AI capex strain. This is a huge factor right now that wasn't there even a few years ago. The estimates in the report suggest that AI infrastructure spending is going to exceed $5 trillion over the next 5 years.
$5 trillion. That is a staggering amount of capital.
It is, and that money has to come from somewhere. Since the system is already completely saturated with debt, this new demand is just adding high beta, highly speculative debt right on top of everything else. We are piling risk on top of risk, hoping the AI boom pays off before that maturity wall collapses.
So that's the problem. We are swimming in a sea of unhinged, unsecured debt that is becoming ruinously expensive to maintain.
A pretty bleak picture.
It is. But the report says the solution, or at least an archetype for a solution, lies in the past. So let's talk about the Hundi system. I never heard of this before reading these notes, but it sounds incredible.
It really is the gold standard of credit in a very literal sense.
Hmm.
The Hundi system originated in ancient India, going way back to the Maurya and Gupta periods. It wasn't some niche practice. It was the absolute backbone of trade for centuries across the subcontinent.
And the key difference here, the thing that makes it so different from a modern check or a bond, is that a hundi wasn't just a promise. It was an IOU against a deposit of physical gold, right?
Correct. Let's visualize it. Imagine you're a merchant in, say, Varanasi. You want to buy spices in Gujarat. That's a long, dangerous journey.
You can't just carry a chest full of gold across the country.
No way. The roads are full of bandits. It's way too dangerous, and it's slow. So you need a way to move value without actually moving the metal.
Okay, so what do?
You go to a shroff, which was the term for an indigenous banker. You give him your gold to hold in his vault. He then writes you a hundi, which is this piece of paper. You travel with this paper, which is light and easy to hide. When you get to Gujarat, you present it to a correspondent banker, and he gives you the value.
It's like teleporting your gold.
In a way, yes.
Mm-hmm.
But here is the critical part, the part we've lost today. The shroff didn't create that money out of thin air. He didn't practice fractional reserve banking in the modern sense. The credit was pegged one-to-one to the existing asset.
So if the gold didn't exist in the vault,
The hundi didn't circulate, period. That's a very definition of real credit. It's constrained by physical reality.
the report lists these different types of hundi, and they are fascinatingly specific. Let's start with the darshani hundi.
The darshani hundi is the speed instrument. Darshan, in Sanskrit, implies to see or on site. It was payable on site.
So instant settlement.
Instant settlement. As soon as you present it, you get paid. This provided finality to trade. There were no waiting periods, the check is in the mail. It was done.
And then there's the opposite of that, the mudadi hundi.
The time bill. This was pure genius for trade finance.
Okay.
Let's say you buy goods, but you need 90 days to travel and sell them before you actually have the cash to pay. You issue a mudadi hundi that's payable in the future.
But again, it was backed by something real.
It was backed by the anticipation of a real asset sale. It allowed commerce to flow over time, smoothing out the liquidity needs of merchants without creating money from nothing.
My favorite one in the report is the Joachim Hundi. It sounds like something out of a maritime adventure movie.
The Joachim Hundi is just brilliant financial engineering. It actually combined credit and insurance into a single instrument.
How did that work?
It was a conditional payment. Let's say you're shipping valuable goods by boat. You would issue a Joachim Hundi that is only payable if the ship actually arrives safely at the port.
So if the ship sinks or gets hit by pirates.
If the ship sinks, the hundi is void. The lender, the person who bought the hundi, takes the loss. It explicitly tied the value of the credit to the physical reality of the trade goods.
So no goods, no debt payment.
Exactly. It forced the lender to actually care about the risk of the venture they were funding. They had skin in the game.
Incredible. And finally, the Sahyog Hundi.
Sahyog means cooperation. This was the social layer. It required endorsements from multiple merchants to be considered valid. It created this interlocking web of reputation.
So you couldn't just burn one person.
No, if you dishonored a hundi, you weren't just defaulting on a faceless bank loan. You were destroying your reputation within the entire merchant community.
Right.
It was social and financial suicide.
So in the hundi system, issuing credit was a productive act. It literally sped up commerce. It wasn't about selling debt to fund a deficit.
Exactly. It was a tool for trade, not a product to be sold for consumption. And that is the core philosophy that Strategy Inc. and Michael Saylor are trying to revive.
They want to go back to that asset-backed model.
They do. But obviously, we can't carry chests of gold around or rely on paper slips in 2026.
Right. So enter digital credit. What's the thesis here? How do you modernize a 2,000-year-old system?
Well, Saylor's argument is that we need to return to the principles of the hundi, that asset-backed issuance. But we need to swap the asset. Gold was the best technology for thousands of years, but it has problems in the digital age.
It's heavy. It's slow to move.
It's slow, and it's incredibly hard to audit. You have to trust the guy guarding the vault that the gold is actually there. There's always that element of trust.
And Bitcoin fixes this.
That's the claim. Bitcoin moves at the speed of light. It's immutable. We know for a fact there will never be more than 21 million. And most importantly, you can verify the reserves using the blockchain.
You don't need to trust the shroff.
You don't. You can verify the math yourself. It's what the crypto world calls proof of reserves. Trust is replaced by verification.
So Strategy Inc. is positioning itself as the new digital shroff.
Yes. They call it the Bitcoin Treasury model. They issue credit, which are these securities we're about to discuss, and they use the proceeds to acquire digital capital, which is their term for Bitcoin.
And this is a key distinction the report makes. Modern fiat debt issuance is usually consumptive. It just gets spent. Strategy Inc.'s issuance is accretive.
Right. And this is so important. Think about it. When a government issues bonds, where does the money go? It goes to pay for services or the military or, interest on previous
The
debt.
money is gone. It's consumed.
It's consumed. When Strategy Inc. issues a security, they take that cash and they immediately buy Bitcoin. They're trading a liability, the debt, for an asset, the Bitcoin,
Okay.
that they believe will appreciate against the debasing currency. They retain the value on their balance sheet.
Okay, so that's the philosophy. And it makes sense on paper, but let's get into the actual product because investors aren't buying philosophy, they want returns. The report dives deep into something called STRC. This is the instrument.
The variable rate series, a perpetual stretch preferred stock. It's a mouthful, so let's just stick with STRC.
Please. So what is it, basically?
At its core, it's a preferred stock with a par value of $100. But the engineering behind it is what makes it digital credit rather than just another stock. It's designed to solve the single biggest problem institutional investors have with Bitcoin: volatility.
And that's the big question, isn't it? Bitcoin is notoriously volatile. It goes up and down violently. How on earth do you build a stable, bond-like financial instrument on top of that?
You do it with a variable dividend. The report uses a great analogy. Think of it like a thermostat in your house. Strategy Inc. wants the price of STRC to stay at exactly $100. No more, no less.
Okay, so walk me through the mechanics.
All right, scenario A. The demand for the stock goes up. Maybe people are fleeing the failing bond market and they rush into STRC. The price rises to, say, $102.
Okay.
The thermostat kicks in. Strategy Inc. lowers the dividend rate.
So the yield drops.
Exactly. This makes the stock slightly less attractive to new buyers, which cools the demand, and that brings the price back down to the $100 target.
And what if the price drops? Scenario B. Say the market gets spooked and the price falls to $98.
The thermostat adjusts the other way. They crank up the dividend rate. Suddenly, the yield on this thing looks amazing compared to everything else in the market. Investors rush in to buy it to capture that high yield.
And the buying pressure pushes the price back up to 100.
Precisely. So the volatility of the underlying asset, the Bitcoin, is effectively stripped out and pushed somewhere else.
Where does it go?
It's absorbed by the common stock, MSTR. The common shareholders are the ones taking the wild ride on the price action of Bitcoin. The STRC holders get a stable value with a high but fluctuating yield. It's like living in a house built on shock absorbers. The Bitcoin market might be shaking violently, but you're sitting steady in your chair.
And the yields we're talking about are not small. The report tracks the history. It IPO'd in July 2025 at 9%.
And as of January 1st, 2026, they increased it to 11% annualized. That's a massive number in the fixed income world. You simply cannot find an 11% yield on a stable, high-quality instrument anywhere else without taking on insane amounts of credit risk.
11%. And the market is responding to this.
Aggressively. The data is pretty clear. Between January 5th and January 11th, 2026, that's just 1 week, Strategy Inc. sold 9 million shares of STRC.
So they raised, what is that?
They raised nearly $120 million in 7 days.
Wow. And what did they do with that money?
They did exactly what the model dictates. They turned around and bought Bitcoin, 13,627 Bitcoin, to be precise. It's a flywheel effect. Issue credit, buy the asset, which strengthens the balance sheet, which allows you to issue more credit.
Okay, so you get 11%. That's great. But here is where the report says it gets even better. They call it the alpha, and it has to do with taxes. This part, I have to say, it blew my mind.
This is the return of capital, or ROC mechanism. And this is where the displacement of traditional debt really becomes a serious threat to the status quo.
Okay, explain this to me like I'm 5. Or maybe explain it to me like I'm an investor who really, really hates paying taxes.
All right. Usually when you get a dividend from a stock or interest from a bond, the IRS treats that as income. You have to pay taxes on it that year. If you're in a high tax bracket, that could be 40 or 50% of it just gone.
Painful.
Very. But because of the specific way Strategy Inc. accounts for its Bitcoin holdings, how they handle depreciation and expenses on their corporate books, these dividends are legally classified as a return of capital. Which means the IRS doesn't see it as income. They see it as you just getting your original investment money back. So the dividends are not taxed in the year you receive them.
Wait, not taxed at all?
Not in that year. Instead of paying tax, you just lower your cost basis in the stock.
So if I bought the stock at $100 and I get an $11 dividend.
For tax purposes, it just looks like you lowered your purchase price to $89. You don't pay a single dime in taxes until you actually sell the stock, which could be years or even decades down the road. You're deferring the tax liability indefinitely.
That is huge. I mean, that completely changes the math on the investment. So the real yield isn't just 11%.
No, not even close. If you're a high net worth individual, let's say your effective tax rate is 45%. To get the same amount of cash in your pocket as an 11% tax-deferred yield, you would need a traditional taxable bond to pay you almost 20%.
20%. You are not finding that in the bond market. Not without buying something incredibly risky, like, the debt from a company that is about to go bankrupt.
Exactly. And that is the displace me argument the report makes. Why would you hold an unsecured junk bond yielding 8%, which is really only 4.4% after tax, when you can hold secured digital credit yielding 11% tax deferred?
It's a no-brainer for anyone who's actually doing the math.
It really is.
But wait, you just used the word secured. Let's talk about the risk. Because the skeptic in me is screaming, what happens if Bitcoin crashes? If Bitcoin drops 50% tomorrow, how do they pay my 11% dividend?
That is the most common criticism, and it's absolutely the first question any institutional investor asks. Strategy Inc. has built what they call a war chest, specifically to address this. They do not pay the dividend by selling Bitcoin.
They don't?
No, that would defeat the entire purpose of accumulating it.
So where does the cash come from?
They hold a massive segregated reserve of U.S. dollars.
Yeah.
As of January 2026, the report says this cash reserve is at $2.25 billion.
$2.25 billion in cash, just sitting there.
It's just sitting there. And their stated goal is to get it to $3 billion. The report states that this cash pile is enough to fund 21 to 24 months of dividend payments without selling a single Satoshi.
So even if we go into a brutal 2-year crypto winter where the price is flat or way down, the dividend is safe.
That's the design. And there's a clear hierarchy of claims. First, you have that $2.25 billion cash reserve. Second, you have the ongoing cash flow from their legacy software business, which is still running and profitable. And third, you have the ultimate collateral, the Bitcoin itself.
How much do they actually have now?
As of early 2026, the report says they hold 673,783 Bitcoin. At the valuations in the report, that's about $62 billion.
Okay, so let me get this straight. You have a $62 billion asset pile and a $2+ billion cash pile backing this credit instrument.
It sounds strangely conservative for something involving crypto, doesn't it?
It really, really does.
And that's the irony. By over-collateralizing it so heavily, they are explicitly trying to make it safer than the government debt we talked about at the beginning of the show.
Right. Government debt is backed by nothing but faith.
Exactly. This is backed by audited map and segregated cash reserves.
It really forces you to rethink what the word safe even means in finance today. Is safe a promise from a government that is drowning in $150 trillion debt? Or is safe a claim on a verified liquid asset with a multi-billion-dollar cash buffer?
That is the question of the decade. And if the market decides that digital credit is actually safer, or at least better risk-adjusted, we could see a massive migration of capital.
We aren't just talking about a few $1 million here and there.
No. We're talking about walls of money, trillions of dollars, potentially moving from the bond market into digital credit.
Which brings us back to that big picture. Is this the beginning of the end for the traditional debt market as we know it?
I think it's a profound disruption. We're seeing the return of a concept that has been dormant since 1704, or at least since 1971. The idea that credit should be tied to reality.
The return of real capital.
Yes. If this digital credit model works, and the early adoption numbers suggest it is working very well, it exposes the fundamental weakness of the fiat debt system. It offers a viable alternative. It's an opt-out mechanism. You don't have to hold the unhinged debt anymore. You can hold credit that is anchored in something thermodynamic, something mathematical.
It really feels like we're closing a very long, very strange historical loop. From the Shroffs in ancient India moving value with paper to avoid bandits.
To the great decoupling, where banks started selling paper backed by absolutely nothing.
And now, back to a digital Shroff moving value via code backed by digital energy.
History doesn't repeat, but it certainly rhymes. And this round is fascinating because it combines that ancient wisdom with cutting-edge engineering. It's using the oldest sound money principles, but executing them with technology that wasn't even possible 10 years ago.
It is a lot to process, and as we start to wrap up, I just want to remind everyone listening, this is a community effort. The analysis in this deep dive is based on publicly available information, specifically that digital credit report, but this story is unfolding in real time. We are literally watching the experiment run.
Absolutely. We are watching a live experiment in financial engineering, and experiments can have unexpected results, both good and bad.
So we want to hear from you. Are we being too optimistic about this? Is there a fatal flaw in the STRC structure that we missed? Is the war chest really enough? Or, on the other hand, are we being too critical of the traditional system?
We want the skeptics, the believers, the finance experts, and the crypto natives. If you have a sharp eye for detail, review our content. Tell us what stands out to you. What did we get right? What did we get wrong?
Drop a comment, send us an email. We're always looking for collaborators to help us refine these deep dives. If you understand bond math or tax law better than we do, please reach out.
Because the goal isn't just for you to listen. It's for all of us to understand.
Well said. This has been a heavy one, but hopefully a clarifying one. The return of real credit might just be the most important financial story of our lifetimes.
Yeah.
As always, keep searching. Keep the quest on.